You walk into a casino. You see the lights, you hear the bells, you see the people cheering at the craps table. It looks exciting. It looks like a place where dreams are made. But if you walk upstairs, into the security room and look at the monitors, you see the truth. You see a mathematical machine designed to do one thing: transfer wealth from the idiots on the floor to the house. Wall Street is the biggest casino in the history of the galaxy, but it's worse than a casino. Because in Vegas, at least you know the odds are against you. In Vegas, they give you free drinks while they rob you. Wall Street charges you for the drink, charges you to sit at the table, and then convinces you that you're a genius for losing money. You're sitting there with your trading app, looking at squiggly lines on a screen, reading headlines about what the Federal Reserve is going to do next Tuesday, thinking you can outsmart the market. You think you're a trader. You think you're an investor. I'm here to tell you that you are not an investor. You are plankton. You are bioluminescent algae floating in an ocean of sharks, and you think you're swimming because the current is moving you. Today, I'm going to teach you how to beat the sharks. I'm going to teach you how to beat 90% of the Ivy League-educated, cocaine-fueled hedge fund managers in New York City. And the best part? You can do it while you're asleep. You can do it while you're playing video games. You can do it while you're in a coma. In fact, the coma strategy is statistically superior to what you're doing right now. We're going to talk about the three-fund portfolio. This is the antivenom to the snake oil of the financial industry. It is boring, it is simple, and it is the only strategy that is mathematically proven to work over a lifetime. So, put down the day trading app. Stop looking for the next crypto moonshot. Let's look at the actual data. The Wall Street scam. Let's start with the fundamental lie. The financial industry wants you to believe that investing is complicated. They want you to believe that it requires expertise. They want you to believe that you need a guy named Chad in a fleece vest to manage your money because the market is a scary, dangerous beast that only he can tame. Why do they want you to believe this? Because if investing is simple, they can't charge you fees. Wall Street does not make money when you make money. Wall Street makes money when you move money. They make money on the friction. Every time you buy a stock, sell a stock, buy a mutual fund, or pay a management fee, they get paid. They are the toll booth operators on the highway of wealth. If you just park your car and sit there, they starve. So they created a culture of action. They invented 24-hour financial news networks that scream at you to buy now or sell now. They created apps that shower you with confetti when you make a trade. They gamified your financial ruin. They want you to be an active investor. What is an active investor? It's someone who tries to pick winners. You look at Apple and say, I think they're going to do well. You look at Tesla and say, Elon is a genius. You try to time the market. You try to buy low and sell high. Here is the problem. The stock market is a zero-sum game in the short term. For you to buy a stock at $10 because you think it's going to 20, someone else has to sell it to you at $10 because they think it's going to 5. Who is on the other side of your trade? It's not another guy in his underwear. It is a supercomputer located 3 feet from the New York Stock Exchange, running an algorithm written by a PhD in astrophysics, analyzing satellite imagery of Walmart parking lots to predict earnings reports before they are public. Do you really think you have an edge over that? Do you think your gut feeling is better than a billion-dollar neural network? If you try to play their game, you will lose. The house always wins. But there is a way to not play their game. There is a way to own the casino instead of sitting at the table. The haystack versus the needle. The late great John Bogle, the founder of Vanguard and the patron saint of rational investing, had a beautiful analogy. He said, "Don't look for the needle in the haystack. Just buy the haystack." In this analogy, the needle is the next Amazon. It's the next Apple. It's the stock that goes 10,000%. Everyone is looking for the needle. They're tearing the hay apart, spending hours analyzing straw, paying managers huge fees to find the needle for them. And most of them fail. They pick the wrong straw, or they find the needle, but they sell it too early, or they buy it too late. But if you buy the haystack, you are buying the entire market. You are buying every single company. If you own the whole haystack, guess what? You definitely own the needle. You own Amazon. You own Apple. You own the winners. Sure, you also own the losers. You own the companies that go bankrupt. But here is the beautiful asymmetry of the stock market. A stock can only go down 100%. That's the floor. But a stock can go up infinity%. The winners mathematically drown out the losers over time. One Amazon compensates for 1,000 failed blockbusters. If you buy the haystack, you capture the average return of human ingenuity. And average in the stock market is a ticket to extreme wealth. The math, active versus passive. Now, you might be thinking, but Doc, I don't want to be average. I'm special. I want to beat the market. Let's look at the scoreboard. There is a report called SPIVA, S&P Indices versus Active. It sounds boring, but it is the most damning document in finance. It tracks how professional fund managers perform against a simple brain-dead index fund. Over a one-year period, maybe 40 or 50% of professionals beat the market. Luck plays a huge role in the short term. But stretch that timeline out. Wealth isn't built in a year, it's built in decades. Over a 15-year period, approximately 90% of active fund managers failed to beat the S&P 500. 90%. These are people who do this for a living. They work 80 hours a week. They have teams of analysts. They have insider connections. And 9 out of 10 of them cannot beat a simple computer program that just buys the 500 biggest companies and goes to sleep. And the 10% who do win, they rarely repeat it. The star manager of the 90s usually becomes the loser of the 2000s. It's randomness. It's survivorship bias. If the professionals can't do it, what chance do you have? Zero. You have zero chance. Accepting this is not defeat, it is liberation. Once you accept that you cannot predict the future, you can stop trying. You can stop stressing. You can fire your financial advisor who charges you 1% a year to underperform the market. You can become a passive investor. Passive investing is admitting that you don't know which company will win, so you bet on all of them. You bet on capitalism itself. You bet that, generally speaking, humans will wake up tomorrow and try to make money. They will invent new things, sell new products, and improve efficiency. As long as that happens, the market goes up. The tool, the index fund, or ETF. So how do we buy the haystack? We use a tool called an index fund, or ETF. An ETF is just a basket. Instead of going to the store and buying one egg, one slice of bacon, and one piece of bread, you buy a pre-packaged breakfast basket. The three-fund portfolio uses just 3 of these baskets to cover the entire global economy. It is the ultimate lazy genius strategy. It takes 5 minutes to set up, and you check it once a year. Here are the 3 ingredients.
Fund number 1, total U.S. stock market, the engine. Examples: VTI, VTSAX, ITOT. The first ingredient is the United States of America. When you buy a total U.S. stock market fund, you are buying a tiny piece of almost every public company in the U.S. You're buying Apple, Microsoft, Google, Amazon, but you're also buying the medium-sized companies and the small companies you've never heard of. You are betting on the American economy. Why the U.S.? Because for the last century, it has been the greatest wealth creation machine in history. It has strong property rights, a culture of innovation, and a currency that the world relies on. Some people will tell you to just buy the S&P 500, the 500 biggest companies. That's fine, but I prefer the total market. Why? Because sometimes the little guys win. Small cap stocks have periods where they explode in value. If you only own the giants, you miss that growth. The total market fund is self-cleansing. If a big company starts to fail, like Sears or GE, it shrinks in the portfolio automatically. If a small company starts to win, like Tesla 10 years ago, it grows in the portfolio automatically. You don't have to pick the winner. The index does it for you. This should be the biggest chunk of your portfolio. Fund number 2, total international stock market, the diversifier. Examples: VXUS, VTIAX, IUXS. Here is where the USA patriots get angry. They say, why do I need international stocks? The US is the best. This is called recency bias. You think because the US has dominated for the last 10 years, it will dominate forever. History says otherwise. In the 1980s, the Japanese stock market crushed the US. In the 2000s, emerging markets crushed the US. There are decades where the US market stays flat while international markets soar. If you were 100% in the US, you are betting that America will never have a lost decade. That is a dangerous bet. Buying a total international stock market fund gives you ownership of Toyota, Samsung, Nestle, Tencent, Shell. It gives you exposure to Europe, Asia, emerging markets. It's a hedge. It's insurance. If the dollar collapses, your international stocks likely go up. If the U.S. economy goes into a recession, maybe the European economy is booming. By owning both the U.S. and the international funds, you effectively own the entire planet's capitalism. You are the CEO of Earth.
Fund number 3, Total Bond Market, the airbag. Examples: BND, VBTLX, AGG. Everyone hates bonds. Bonds are boring. Bonds don't go to the moon. But you need bonds. Stocks are like a race car engine. They are powerful, but they vibrate, they overheat, and sometimes they explode. Bonds are the suspension system. They smooth out the ride. A bond is basically a loan. You are lending money to the government or companies, and they pay you interest. They are generally much safer than stocks. Why do you need them? Because of human psychology. The stock market will crash. It is not a matter of if, but when. It will drop 30%, 40%, maybe 50%. When that happens, if you are 100% in stocks, your portfolio gets cut in half. Most people think they have diamond hands. They think they can handle it. But when they see their retirement savings vanish, they panic. They sell at the bottom. That is how you stay poor. Bonds usually hold their value, or even go up when stocks go down. People flee to safety. If you have some bonds in your portfolio, your drop isn't 50%. Maybe it's only 30%. That psychological difference prevents you from jumping out the window. Bonds are not there to make you rich, they are there to keep you in the game. The allocation, how to mix them. So you have your 3 ingredients: flour, water, yeast. How do you bake the bread? This depends on your risk tolerance and your age, but I'm going to give you a standard template. I call this the I want to be rich, but I also want to sleep allocation. 60% total U.S. stock market, VTI, 20% total international stock market, VXUS, 20% total bond market, BND. This is a balanced, robust portfolio. If you are young, under 30, and you have nerves of steel, you might lower the bonds. Maybe 10% bonds or even 0% if you're crazy. If you are older, near retirement, you increase the bonds. Maybe 40% or 50% bonds because you can't afford to lose money right before you need to spend it. But the exact percentages matter less than the philosophy. The philosophy is broad diversification, low cost, buy and hold. The fee killer, expense ratios. Now we have to talk about the silent killer, the termite in your house, the tapeworm in your stomach, fees. In the investment world, you get what you don't pay for. Every fund has an expense ratio. This is the percentage of your money the fund manager takes every year to run the fund. Active mutual funds, the ones your bank tries to sell you, often have expense ratios of 1% or higher. Index funds, like VTI, have expense ratios of 0.03%. You might think, Doc, 1% is nothing. Who cares? Let's run the math. Compound interest works both ways. If you pay 1% in fees every year over a 40-year investing lifetime, you will lose approximately 30% of your total potential wealth. Think about that. You take all the risk, you save all the money, and the fund manager takes 1/3 of your harvest just for picking stocks that underperformed anyway. It is highway robbery. The 3-fund portfolio uses ultra-low-cost ETFs. VTI costs 0.03%, VXUS costs 0.07%, BND costs 0.03%. Your total weighted fee is practically zero. You keep 99.9% of your returns. This is the only way to win. Rebalancing, the only work you do. I told you this was a lazy strategy, but you have to do one thing, once a year. It takes 10 minutes. It's called rebalancing. Let's say you start with your 60-20-20 split. Over the year, the U.S. stock market goes on a tear. It goes up 20%. Bonds stay flat. At the end of the year, your portfolio might look like 70% U.S. stocks, 15% international, 15% bonds. You are now out of balance. You are taking too much risk. So what do? You sell some of the winner, U.S. stocks, and buy the losers, international and bonds, to get back to 60-20-20. This forces you to do the hardest thing in investing: sell high and buy low. Most people do the opposite. They buy what's hot, buying high, and sell what's crashing, selling low. Rebalancing forces you to be a contrarian. It forces you to take profit from the casino and put it into the safety deposit box. You do this on your birthday or New Year's Day. Pick a date, log in, click a few buttons, log out, see you next year. The execution, how to actually do this. So where do you buy these ETFs? Do you go to a bank? No, never go to a bank for investing. They are salespeople. You open a brokerage account at a discount broker. Vanguard, Fidelity, Schwab, it doesn't matter. They're all commodities now. You transfer money from your bank. You type in the ticker symbol, e.g. VTI. You click Buy. You choose Market Order. Done. Repeat every month when you get paid. This is called dollar cost averaging. Some months you buy when the market is high, some months you buy when the market is low. Over time, you pay the average price. You remove the emotion. You remove the timing. You just feed the machine. Conclusion: boring is beautiful. I know what you're thinking. Doc, this sounds boring. Good. It should be boring. Investing should be like watching paint dry or watching grass grow. If you want excitement, take $500 and go to Vegas. Go skydiving. Ask out someone out of your league. But do not look for excitement in your life savings. Your money has one job: to multiply, to buy your freedom, to provide a shield against the chaos of the world. The three-fund portfolio is the shield. It is the sword. It is the fortress. While your friends are panicking because their crypto crashed or stressing because their tech stock missed earnings, you will be sleeping like a baby. You own the haystack. You own the world. Wall Street hates this advice. They can't monetize it. They can't sell you a newsletter about it. They can't put a strong buy rating on it. It's just math. Cold, efficient, beautiful math. So fire your broker. Close your day trading account. Buy the haystack and go live your actual life. Class dismissed.